Hi, and welcome to part 2 of the two-part series on how companies cook their books. In part 1, we examined a number of creative accounting tricks and techniques that companies employ to manipulate the revenue. We looked at how companies extend the revenue booking period, how sales in excess to the work done is recorded, and how revenue is manipulated in lease transactions. In addition to stretching the revenue, we also discovered some bogus techniques in that video on how companies create revenue out of thin air. I hope you found that video useful, and in this video we'll examine the lower end of the funnel, that is how companies manipulate the profit numbers and boost their earnings using a combination of unprincipled accounting strategies. This video, like the previous ones in the series, has borrowed heavily from the book Financial Shenanigans, which in our opinion is a must read for anyone who invests money in stocks, irrespective of whether you do the research yourself or rely on others. Do remember, our purpose of making this video is entirely educational, and we request you to do your own research before transacting in any financial instrument. With that being said, let's begin. A fairly simple way to hide expenses would be to pretend that you never saw the bill or invoice. And while some companies do make monthly or quarterly provisions for unreported vendor expenses, but if you want to hide these expenses and show a higher income, then simply hide that invoice, which would be the easiest way to go about it. Now, speaking of vendors, an interesting and unusual ploy that some companies use to artificially reduce expenses is to receive sham rebates from suppliers. Here's how this works. So as a company, let's say you confirm to your supplier that you'll buy 10 lakhs worth of office supplies next year. Now you and the vendor know that the actual cost of these office supplies is only 9 lakh rupees. In exchange for this order, say you also convince the supplier to pay that additional 1 lakh rupees as upfront rebate, which your company then promptly records it as a reduction in office expenses for this quarter. So effectively, by using this trick, you have preponed your profits by 1 lakh rupees in this quarter itself. If a company does this with enough vendors, then the single trick can potentially bring crores in profits to the company. Now, as an investor, the best way to detect an unprincipled activity like this is to look at any unusual cash inflows from vendors with suspicion. After all, in a normal trade scenario, cash is supposed to flow from the company to the vendor and not the other way around. The word reserve represents that part of a company's profit that is kept aside or retained in the business to meet some future situation. These situations are generally the more difficult ones, and having a reserve helps the company stay financially stable. Now, reserves are used for a number of situations like meeting contingencies, paying back loans, stabilizing dividend payments, growth expansion, etc. And as a practice, keeping a reserve is generally appreciated within the accounting community. However, what is not appreciated is the deployment of a reserve's credit balance with the sole purpose of boosting a company's profit. Take, for instance, what happens with reserves when it's kept in service warranties. You see, companies often bundle expensive warranties with their products, which are aimed at covering problems that could arise years after the purchase. For example, if you were to purchase a laptop, then more often than not, it would come with a 2-year warranty that would guarantee the repair or replacement of a defective part. Now, prudent accounting requires companies to create a reserve in their books to address the costs associated with this warranty. But we also know that the management can exercise great discretion in the amount it records as the warranty expense. So if it chooses too little, then the profits shoot up, and if it chooses too much, then the profits are constrained. As an investor, the best way to understand this is to watch out for the quarterly trend of warranty reserves as a percentage of revenue. If you see this number declining, then this is a signal that earnings might be getting inflated because of an under-accruing of warranty obligations. A common trick used by companies to reduce expenses is to capitalize them. For example, say an insurance company is coming up short on its annual targets. The solution is to run an advertising campaign in the Jan-Feb-March quarter, which would come to about 100 crores. This is easier said than done for this insurance company, which is expecting to make only 80 crores in revenue. So what does this company do? Very simply, the company ignores the generally accepted accounting principle of treating advertising expenses as operating expenses and instead treats advertising as an asset. So the creative thought here, or might I say the justification here, is that the advertising is not going to benefit the company for 1 or 2 quarters, but maybe for the next 4 years, which believe me is absolutely preposterous. However, for any accountants out there, this would be about making a few simple entries in their books of account. So the amount of 100 crores is moved to the balance sheet under the asset column, and a sum of 25 crores is charged as depreciation on a straight line method to represent 4 years of amortization. The result, the company gets to run its advertising campaign, and it does so without jeopardizing its profitability numbers. Now, on the face of it, capitalizing an expense like advertising might seem harmless to some, and to others, it might even seem useful as it allows the company to show a healthier EBITDA in the near term. However, if this approach of capitalizing operating expenses were to continue year after year, then before long, the company would end up with a large accumulation of depreciation items which can potentially wreck a company's profitability for many years. Thankfully, there are a few warning signs that investors can bank upon to detect this practice. These include any unwarranted profit margin improvements, a big unexpected decline in operating cash flows, and of course, a spike in capital expenditure which is above and beyond the original guidance that's given by the management. In fact, one believes this capitalizing trick is something one should be super careful of with companies that are going in for an IPO. You see, showing strong earnings is a successful part of a successful IPO playbook, and promoters would do anything for that, including the capitalization of marketing expenses to show a higher profit number. So if you take time to read the red herring prospectus, then do be sure to check out which expenses are being capitalized. Most big companies have a pretty active M&A team which is always on the lookout for buying and selling companies. Of course, since these are one-time events, it's logical that any gains or losses made from these transactions should be treated separately as they have no relation to the ongoing operations of the company. But if we leave this decision to a creative accountant in an unprincipled company, it should come as no surprise that he or she will find a way to take advantage of these events. For instance, the book Financial Shenanigans shows how IBM used a similar situation to show an increase in profits in its income statement. You see, in 1999, IBM was going through a rough patch and its costs were growing faster than its revenue. As a consequence, everyone expected the management to show a flat or at most a low single-digit growth for the year. But to everyone's surprise, IBM reported a 30% increase in its operating income and a 21.9% increase in net profits. The table here shows that a major reason for this increase in operating income and net profits was the massive reduction in the company's SG&A expenses, that is, the selling, general, and administrative expenses. Now, SG&A expenses typically grow in line with the growth in revenue and costs, which in our case was between 7 and 9%. And thus, it was a bit of a shock when IBM reported that these expenses had not gone up but had come down by a noticeable 11.6%. It was only when some diligent investors dug deeper that it was discovered that IBM had actually netted off a $4 billion gain that it had made on selling one of its businesses as a reduction in the SG&A expenses. In other words, IBM had magically used a non-operating gain from sale of a business to hide some parts of its operating expenses for that year. In fact, if we adjust out the $4 billion gain from the SG&A expenses, we can see the actual extent of the problem. As the table shows, what IBM was showing as a net profit growth of 21.9% might have actually been a degrowth of 20.2%. This example here shows the importance of reading the footnotes in financial statements because generally that's where the unscrupulous management teams often hide their expenses in a bid to boost their profits. The profit and loss statement of a company can be broadly divided into two sections. The first is the operating part, which includes the revenue generated and the expenses incurred as a regular part of running the business. And secondly, there is the non-operating section, which is where unrelated incomes and expenses go. This includes items like the profit or loss made from investments, foreign exchange gains or losses, sale of a subsidiary, sale of a factory, etc. Now, investors, which includes you and me, we typically pay much of our attention to the operating income part in assessing a company's health. There is a lot of logic to this, but what it also means is that it gives some companies a big incentive to improperly shift non-operating gains to the operating section and conversely shift operating expenses or losses to the non-operating section of the P&L account. So while this shifting or misclassification of income has no impact on the net profits, it can create a very misleading picture for investors. In fact, one of the most common ways of shifting normal operating expenses below the line is to write it off as a one-time cost. For example, let's say a company wants to close down a few unproductive branches. Now, this is something that companies do often and should ideally be considered a part of the normal day-to-day functioning of the business. But closing a branch has a few additional expenses like paying severance to employees, paying a penalty for breaking the office lease, shifting of equipment, etc. Now, ideally, these costs should come under the year's operating expenses, but if a company wants to keep them away from the operating section, that can do so by being a little creative. Like in this case, the company can present the closing down of branches as a restructuring plan and can then proceed to record them as a one-time charge in the non-operating section of the P&L account. This way, the company has converted an operating expense into a non-operating one, and any evidence of this would almost always be hidden in the footnotes of the financial statements. Remember, using accounting guidelines is absolutely fine, but abusing accounting guidelines is what we as investors are absolutely against. Yet another trick to magically improve a company's operating profits starts off with an announcement to sell a money-losing division. Let's understand this with an example. So we have a company that has three divisions, A, B, and C. Division A's net profits are 1 crore, Division B makes 2.5 crores, while the struggling Division C has a loss of 4 crores. When we sum this together, that is 1 plus 2.5 minus 4, we get a consolidated loss of 50 lakhs for the business. Now this company, like any other company, does not want to show a visible loss. So what does it do? Very simply, it decides to put up Division C for sale at the beginning of the financial year and accounts for it as a discontinued operation. In doing so, that entire 4 crore loss gets moved from the operating section of the P&L account to the non-operating side, which improves the chances of investors ignoring this loss. But what's interesting is that in spite of this inter-P&L account movement, the company continues to operate all three divisions at a combined loss of 50 lakhs. However, when it comes to reporting, it reports an operating income of 3.5 crores and a supposedly unimportant non-operating loss of 4 crores. It's an accounting trick that we have seen being used quite often by dishonest companies and something that we hope investors will look into with more attention. Innovative, creative, and aggressive. These are not the kind of words that one associates with a function like accounting. But if you have learned one thing from our two-part video series, it is that accounting too can be as imaginative and as corruptible as any other function that the business controls. In this video, we looked at how companies purposefully misrepresent their true profits by either boosting them or hiding expenses using a number of questionable practices. Some of these tricks and techniques were outright frauds, while a few others deviated from the spirit of the widely accepted accounting guidelines. Over time, we have seen these practices only increasing and getting more complicated, which only adds to our appeal that investors should get into the habit of reading financial statements from top to bottom to get a better insight into the company's operations. As an investor, get into the habit of looking out for signals that show an overestimation of revenues, as we learned in video 1, the lowering of depreciation charges, the delaying of expenses, masking of contingent liabilities, the manipulation of inventory, improper capitalization of expenses, and other unusual charges in the profit and loss statement, cash flow statement, the balance sheet, and the accounting policies used by the company. I sincerely hope between these two videos, we have been able to present a number of situations on how some unsavory companies use creative accounting to mislead investors. I would strongly advise everyone to read up more on this subject, and over the next few months, we'll make sure that we do a lot more case studies on the ET Money YouTube channel. Thank you for your time. Please do share this video with your friends, subscribe to the channel, and I'll see you again next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.